No, Kamala Harris is not looking to tax your unrealized gains. Have you watched the news recently? You might have heard Harris to tax unrealized gains. Comrade Kamala is coming to tax your home. Oh my God, no way. Well, as always, political fear and misinformation rules the media landscape. Honestly, if you're making less than $100 million per year, you're probably gonna be safe and sound. As your friendly tax strategist and accounting firm owner, I'm here to set a few things straight. So stay tuned and watch until the end to see what this is all about. Hey friend, my name is Eric Niem. I'm an accounting firm owner and a tax strategist that helps high growth companies and entrepreneurs with their finances. Also, I'm self-admittedly a complete tax nerd. So let's first talk about capital gains tax and how they are paid. First of all, capital gains tax is a tax that you pay when you sell an investment or an asset and have a profit after expenses. The profit after expenses is taxed at a short-term capital gain or at a long-term capital gain based on how long you hold this asset before selling. Currently, there's no tax provision to tax you on your gains before you sell them. Now, in the fiscal 2025 budget plan for Biden and Harris, there was a call for a minimum wealth tax of 25% on the annual income of taxpayers with a wealth of more than $100 million. Now, personally, I don't see how something like this would pass, as it's incredibly hard to both value these assets, if not publicly traded stocks, and also incredibly hard to assess the true amounts of holdings due to most high net wealth holdings, assets over multiple entities and trusts. On top of that, over 80% of these assets in the qualifying amount must be tradable, meaning that startup founders, pre-IPO, and privately held family corporation shares are probably going to be exempt from this qualifying amount. Now, if you're a member of the $100 million club, well, it's probably time to get very proactive. You should get concerned and look to move assets to probably an irrevocable trust or start thinking about passing on your assets to your heirs. Now, if you're like most Americans, making under $100 million per year or $100 million of assets, you have no need to worry about this. Now, that said, there are a few additional tax hikes associated with this budget proposal that are going to be relevant to you. Number one, the qualified business income deduction is set to expire in 2025. Now, this tax deduction allowed small business owners to deduct up to 20% of their net profits, or owners pay against their taxable income. Now, the expiration of this will effectively raise small business taxes by 20%. Now, starting in 2026, you will start needing to make larger estimated tax payments. Number two, they are considering looking to raise the tax rate on capital gains and dividends to the same rate as ordinary income tax, but only on incomes exceeding $1 million per year. Now, currently, the long-term capital gain tax rate caps out at 20%. Long-term capital gains may potentially move up to 39% or the top tax bracket, plus a 5% net investment tax. So if you are a wealthier investor, you may want to consider selling long-term holdings before the end of 2025 to realize a lower tax rate if making over $1 million. Number three, they are looking to remove the step up in basis for heirs. Now, currently, those inheriting stocks, bonds, real estate, or other assets only pay tax on the sale of those assets on the difference of the value of those assets at the time of the original owner's death and the time of sale. This originally allowed heirs to completely sidestep the tax on the appreciation of those assets when originally purchased. Now, one of the biggest loopholes that will be eliminated if these were all to pass would be the borrowing against stock assets for tax-free income. Basically, the uber wealthy would hold on to stocks indefinitely, borrow against those assets for spendable cash, and never sell. Now, when they died, those stocks would be sold to pay off the debt, and the heirs would have a step up in basis, also wiping out all of the income tax. And honestly, it was one of the biggest wealthy loopholes in all of history. So what does this all mean to you? Well, if you are a business owner or are making $1 million plus per year, it's time to start updating your estate tax plan. I always find that those who are educated and are proactive on your tax planning will often do very well when tax codes change. Be proactive, always prepare for the worst, but hope for the best. Now, if you've enjoyed this video, make sure to give it a thumbs up and share it with a friend. And if you're concerned about the shifting landscape of small business taxes, click on the link in my bio for a free report on the top 10 tax strategies we implement with our wealthy clients. Thanks for watching, keep your head up, keep building, and I'll see you again.